I will record this as always, so I can send on the replay. We'll just wait for one more minute so we get perhaps some more people. I'm going to mute you guys. If you want to ask a question or something, you can unmute yourselves so that we avoid the background noise. There's a few more people coming in. Just 1 second. All right, we're going to get started. I hope everybody can see me and hear me well. I am going to share the screen as always. And give me 1 second. Very good. For some of you, this might be the first time joining. So I'm going to cover some things that are more generic. But with these monthly calls, generally it's about the current markets. But let me start. Just bring up the participants window, so I can. I have a few more people on wait list. I'm sorry about that. 1 second. So yeah, welcome everybody. I hope you're all well. Again, starting with some concepts that I like to use, and starting with the idea of the portfolio being a team. You're being the coach, and you decide basically how you want to play. You know, whether you're looking to win the football match by 1-0 or 5-0 or whatever. You know, how aggressive you want to be, which players you want to add to perform those functions. And it's important that those functions will do that job, and how you actively rebalance this team. I think these components, ultimately the goal as a team for your entire portfolio is to protect the capital and compound. Obviously, the ideal scenario is every single player makes money every single time. That would lead to potentially the risk of false diversification. This idea that, you know, and as we've seen in the past, you feel that your portfolio might look diversified, but very often we find that equity, credit, high yield, EM commodities might be expressions of the same trade, particularly during crisis. We saw that clearly in every previous crisis, where perhaps the role of more defensive strategies like Igneo hopes to be is anti-bubble strategies can play. You obviously have the other extreme, very risk-on markets, melt-up scenarios, which we'll discuss. But again, my point is this is about the team and winning as a team. So hopefully, you know, as an individual player, we can contribute to that. And yeah, it's been a difficult time for us the last few months after an extraordinary strong performance during the crisis. But you know, we think we're in a good spot to what might be ahead. When you think about this idea, there are two very important dimensions, in my opinion. One is you need to think about the risk on, risk off. This idea you can't just play with strikers. And here we see two typical strikers might be equities and credit. Both of them are likely to do well during benign markets, you know, through capital gains and income. Both of them might suffer during other periods like more hostile markets. If you think about the midfielders, you know, things that are less correlated, or perhaps, you know, real assets or even cash as an extreme, I would argue that cash is more of a striker in the bench for many people. It's money on the sidelines. It's not really a player, but we could argue that is more in the midfield. And then you can think about the defenders, whether it's volatility strategies or anti-bubbles. But historically, we've seen government bonds playing this role. As we'll discuss shortly, I think government bonds have lost significant, particularly in Europe, and other parts where nominal yield is already negative, the defending power is tricky. But one way or the other, I think it's important to build a team with this in mind. You can't just play with 11 strikers. You can't play with 11 goalkeepers. I think you need them all at all times. But the second key thing that continues to, I think, gain traction, and it's critical to understand, is whether you're long or short inflation. That's the second filter I would call for when we think about basically the portfolio construction, and that's where I would make a big difference between players that will benefit from inflation and some others that will suffer from inflation. And here we know that corporate credit or cash or fixed income, the $100 or euros that you might get in 5, 10, whatever, 20, 30 years, I think 100 euros in 30 years are not going to buy you much at all. And so in a way, I think that a lot of what's happening, we need to be mindful and perhaps avoid these kind of players. And particularly for the fixed income part, this is a major problem as there are ginormous positions in people's portfolios. And I think this combination of credit, bonds, fixed income are going to pay for the party, are going to pay for the abuse that we're seeing. So I think it's a major consideration. With that, I'm going to touch on some points that I made last month, but I think are incredibly relevant as everything is starting to revolve around taper. And so I'd like to review this again and put in perspective for those who missed it. And here what you see is basically U.S. interest rates, Fed funds, short-term rates in blue versus the size of the balance sheet. And this is a historical perspective. We're looking at things from 98 going into the dot-com bubble. And we saw that once upon a time, we had U.S. interest rates at 6.5%. Obviously, the dot-com crisis resulted in a major move down. But if you remember, we went all the way down to 1%. And that was where we reached the floor. And there was no material increase in the size of the balance sheet. So it was pretty much everything done through the monetary interest rate lever. As we have the revenge of the old economy, commodity markets, China strongly picking up, we went all the way to 5.5%, which is where things sort of stalled. And into Lehman, we know what happened. And that's when, for the first time in many decades, we went all the way down to zero. You then see also the big jump, or looked big at the time, in basically balance sheet size, because as QE, not only we brought interest rates to zero, we started to buy a lot of government bonds, effectively the printing and lending, and the left pocket was lending the right pocket. And this dynamic with QE1 then gave way to QE2 and QE3. And in the meantime, we had the European crisis, which brought Europe to basically bring negative interest rates, which for me was kind of a game changer. Is one of the things that led me to write the anti-bubbles, is this idea of where are the limits? Is it really as simple as that? And we saw how 0% stayed for a very, very long time. And the balance sheet size increased enormously. What we saw following that was taper. So this idea you would start to reduce the accumulation, stabilize, and eventually tighten. It was later that you see the hike. And we see that in this particular occasion, several years went by before, after the taper, before we hiked. And the hike was sort of going on its way to normality. Then, Q4 2018 happened. We had this quantitative tightening taking place. And what is interesting is that by the time we got to 2.5%, things already started to blow up. And as you may remember, in Q4 2018, we had a meaningful shock. There were pretty big companies like GE and others that were virtually bankrupt at the time, and they were somehow saved. But it's interesting to see that this prior to COVID, which followed, we were already we had already decreased rates to about 1.5%. So the central banks realized that perhaps decades of loose monetary policy and massive increase in debt, guess what? You couldn't increase the interest rates to where you were before because of the debt servicing, amongst other things. This is true for every single sector, and obviously, at that point in time, we had COVID, and COVID basically was a shock without precedent, which brought us all the way down to zero. But it also created this phenomenal increase, which makes QE1 look like a dwarf relative to the size, the speed, and the scope, which was expanded beyond fixed income and government bonds to other asset classes. And we are now seeing this week a bit of noise with respect to some of these programs helping out on the corporate sector, how perhaps we should at least reduce the speed at which this is happening. And obviously, we are now in a whole new phase of MMT. And so this dimension, this perspective of monetary policy versus the balance sheet it's important, but I think it becomes more complete as we also add one more dimension, which is the term structure of interest rates. And here what you see is yet again in blue the same graph as before, which is short-term rates. But what I've added there in green is the 2-year dollar rate, and then in sort of light orange the 10-year, and in dark orange the 30-year. And what you see is that once upon a time we had a relatively high level of interest rates with a relatively flat curve where things would move somewhat in parallel. What the dot-com brought was a massive reduction in short-term rates, but to a certain extent it was seen as transient, and long-term rates staying high, but within some degree of clear bull steepening. The situation when things normalized, you had the long end rates, as you would expect, much more stable, but it was the short end sort of catching up. And I think it's remarkable to see that where short-term rates actually stopped hiking. They stopped pretty much at the level where long-term rates were. So it's as if the long-term rates at that point in time were actually a really good predictor of a normal state of rate. But obviously, QE in 2008 brought a meaningful change. As you can see, the collapse in short-term rates and 2-year coming pretty much all the way to zero. And then how the back end remained more concerned, perhaps initially, about inflation with money printing, and stayed relatively high. But subsequently, with the European crisis and the introduction of negative interest rates and the search for yield, the curve continued to flatten in a bull flattening manner. Then, as we move on and we try to normalize into 2018, here it's interesting that people like Goldman and many others were calling for perhaps further tightening in short-term rates all the way to catch up with long-term rates. And I think this, which was probably the best prediction of the market at the time, did fail. You didn't quite get there. The damage was already big enough that you couldn't quite get there, and you imploded. And you see the result after 2018. And I think since then, a very relentless move, which obviously exacerbated by COVID. Now, where we're now and what we've been seeing is a humble effort from the market to, with inflation expectations, with the recovery, to sort of see how high can long-term rates go, and perhaps might be an indication of what is the level where if and when you start hiking, you might find that equilibrium. But I think it's relevant to put things in perspective relative to how long we spent at zero, how many years, and how we've continuously failed, and how this kind of ceiling has been moving, and that prediction has actually failed in some way or become a more benign perspective or optimistic view. So I think to the extent that long-term rates have somewhat overestimated that cap, and seeing where we are now, the first question is about taper. Should we reduce the pace at which we are accumulating or printing, and still perhaps a long way to go before we actually see actual rate hikes? So I think this, is this the new ceiling, what we're seeing in the back end? I think the trend is likely to continue. The long-term rates will be some indication of if and when we hike, but my view, as you might know, is quite contrarian. I'm of the view that we will see, inflation going up significantly, and also long-term rates and short-term rates lower. So this brings me on to the next key question, which is, and I half joking, I have teenager kids. So if I am to explain the markets to my children, and I was to use an analogy from video games, for lack of a better one, I would say that there are three levels in this game. The first level in the video game is, can you make money in nominal terms? So can you make your 100 euros or $100 more than 100? Can you return more than zero? That is the way we've played the game for the longest time, and it's still very much in our heads. The second level is, can you make money in real terms? Can you make money basically inflation adjusted? Not only what are your 100 euros going to buy you in 10 or 20 years? And that's a much more difficult game. And as we will see now, it's already, we're deeply into not only nominal, but also in some parts of the world, but pretty much everywhere on negative real, which is part of the, in a way, financial bullying that we're seeing, or you can call it other things. But the third level and final level is, can you make money in real terms after taxes? And there's some debate on the taxes front. I think it's clearly coming, and we'll try to square the circle later in terms of what it means. But it's clearly a consideration. So looking at this in more detail, we see the difference here between the 10-year nominal rates or yields in the Treasury versus if you remove if you look at real rates, the difference is the inflation break-even. And we see how inflation break-evens for the longest time were pretty stable, around 2%. That was kind of the expectation, is in a way what the market or the central banks were hoping. For those of you who've listened to me before, you may have heard my view on the inflation as the frog in boiling water. And for those who are not familiar, I would tell you that I think that the 2% inflation target that we've used historically is not a random number. It's a scientifically calculated number that is sufficiently high so that you will be diluted quite fast. So over 10 years, you lost over 20% compounded of your purchase power, but it's small enough that on a year-by-year basis, a 2% inflation may not be sufficient for us frogs to jump off the monetary froth or broth. So in that sense, I use the analogy because obviously a frog that is in boiling water, will try to jump out. If you put it in mild water and boil it, it will die. So I think we feel a bit the same, and this 2% was sort of that level which was contained. But and we were, for the longest time, really in a world where it wasn't so much of an issue, because at the end of the day, your nominal rates were sufficient to pay you and compensate you for inflation and more. At least official inflation, which I honestly believe is not a fair reflection of real inflation, of what we truly suffer. And I think in that sense, the inflation basket is something that each one of us, we have different baskets. Some of you might have babies and have nappies in your basket. Some others, like me, might have kids going into university, and so we have different things happening. But I think what we see is that things get really interesting around 2011, where you start to see actually negative real yields, and that lasted for a relatively short period of time. We had a lot of things happening. It was sort of a deflationary period with European crisis. The deflationary pressures, putting break-evens below 2%. But then, with the recent dynamics, we saw that deflationary pressure significantly increasing. But since then, and the response that we saw from central banks has just made this thing go one way. And that one way with MMT is a very significant increase in inflation expectations and break-evens significantly above 2%. We saw last month, a major surprise print of 4.2%. That was meant to be, or it's claimed to be transient or temporary. I believe a lot of the inflationary pressures are much more real and sustained, and they're coming from the money printing. And so we're in this situation where arguably, for the time being, the market's trying to figure out whether we're playing by the old rules, which is basically inflation's coming, central banks will have to hike interest rates, or whether, which I believe is the case, there's a new paradigm. The rules have changed, and central banks cannot hike interest rates, because if they do, the bubbles of it they've created will blow up. And so I think we're in a very interesting and dangerous point where we'll see what happens, but inflation is clearly accelerating, and we've seen the Federal Reserve all the way since last summer, which was a kind of a turning point in the markets, them changing their stance with respect to 2%, no longer being a ceiling, but rather being a long-term average, which means they've given themselves room to be substantially above 2% for a period of time. And here we're going to see a little bit of be careful what you wish for, because obviously they want inflation, they need it, but there are quite adverse consequences, which we're aware of. So the best case scenario that they're hoping for, which is inflation increases at a rapid pace, but not so high that it disrupts things, is what they're hoping for. We'll see if they can achieve it. But in the meantime, there are other things to consider, such as the risks of the bubbles that, in my view, they've created. So in that sense, looking into tapering, we see perhaps how some central banks have already started. The U.S. is lagging, and a lot of eyes looking at Jackson Hole as a potential announcement at the end of August. For the time being, the narrative of the Federal Reserve is inflation is temporary. Things will ease off towards the end of the year, and that's the game they're playing. And for the time being, the market is comfortable with this dynamic. So what just taking a zoom out, for those who are not familiar with the thesis, I believe that this is still part of the game. They are central banks have been trying for decades just to every time we face a problem, we try to solve it by printing money, and this is something that, in my opinion, doesn't really solve problems. It does four things. It delays the problem in the form of just kicking the can down the road with more debt. It transfers the problem in the form of currency wars and trade wars, which are trying to pass that problem to your neighbor. They transform the problem clearly into things like inequality and inflation, and ultimately they enlarge the problem through bubbles and social and other issues. So I am very critical of this. I understand why they do it, And I think it's put the central banks in a trap, and it's creating a situation that looks, in my opinion, is significantly more fragile than it might look. So in that sense, this idea of monetary policies without limits, goes hand in hand with the other side, which is fiscal policies without limits. And here, MMT is just this new paradigm where theoretically you can just spend as much as you want, borrow as much as you want, and you can do that even without raising taxes, because it's all happening through basically money being printed. So this is clearly more of the same, a very dangerous combination, which we see what's doing. A lot of debate now in the US with respect to taxes and a lot of pushback. And yeah, I think in that sense, you're familiar with my view that if I summarize the last decade as the transformation of risk-free interest into interest-free risk. And I unfortunately think that the next decade, it's about the transformation of bubbles too big to fail into inflation, or perhaps stagflation. So lots of things to consider with COVID or other excuses to be used to continue with this, and many things that are sold to us as short-term always then, whether it was QE back in 2008, this is a one-off, it will go away. Every single time these things become permanent. And so there's a big danger now with MMT and checks sent to people. And this is something that is, in my view, not very healthy for the economy. So we've seen this major disconnect between the markets. And as I said earlier, I think we have bubbles that are too big to fail. This is a new enemy. Central banks look for financial stability. That historically has meant inflation. Right now, what it means, in my opinion, the financial stability, the risk comes from the bubbles imploding. If the bubbles were to implode, take your choice, fixed income or equities or anything, because there's absolutely, some of you might be arguing, well, it's not really a bubble. Why do you say it's a bubble? Well, it's a bubble because when you value something, when you think about how do I value an asset, we're doing that by basically discounting cash flows, right? So you have a situation where if an investment is going to pay you $100 in 10, 20, 30, 50 years, what's the present value of that? Well, you obviously need to use a base risk-free interest rate, which doesn't really exist anymore. And then you need to apply, perhaps, as we said, inflation and credit spreads. But what you see is that in a world where interest rates are grossly artificially cheap, and take, for example, 0% nominal, what you see is obviously the present value of $100 at zero interest rates, it's 100. And that's true for, across the curve. So you have a situation where this is part of the reason why growth versus value has diverged so much, is the duration element, the sensitivity to interest rates, and how artificially low interest rates can create artificially high equity valuations. And I feel very strongly that what we're seeing today is 100% artificial. Okay, it doesn't mean it will implode tomorrow, but it's artificial. It's a construct that happens through artificially low interest rates. And as much as I love my country, Spain, the fact that we can finance ourselves at negative nominal yields is just complete stupidity. It's not a fair reflection of our ability to repay or whatever. It's 100% artificial. And this has domino effect, etc. So these bubbles, this candle rate of these valuations are, in my view, as I keep saying, by now too big to fail. And we saw a bit of a warning in Q4 2018 with where central banks had to revert their policies, their hikes very quickly, and provide some support, because the collapse would mean lots of bankruptcies, lots of unemployment, lots of deflation, and ultimately they would need to come to the rescue anyway. So we might as well do it up front and avoid the collapse, because we're going to have to do it anyway. And this is the really unfortunate, tricky situation where we are, which means that, in my opinion, the normalization of monetary policy is plain and simply science fiction. And so the idea that you can and should taper, I agree, and it will come, but I think it will come at a very, very low pace, not to upset the market. And I sincerely I have serious questions of if and how the central banks will be able to hike rates, because I think, we might see this risk markets being a pressure before even you get these hikes, but time will tell. So in that sense, I was an important point I've made before, and I think is very relevant with respect to long-term rates and the bubbles, is this kind of disconnect between much higher equity markets and much lower fixed income markets, where the relationship here is clear. As long-term interest rates go up, as it's been the case with inflation picking up, you get treasuries collapsing. But on the other hand, how the equity markets have taken it very, very nicely. Part of that is because of the effect of duration. And I want to elaborate on that. I think some of you heard this before, but I think it's important because I don't think many people are talking about this, is the idea that, yes, equities have, are sensitive to interest rates. And, even if most of us probably agree that equities are expensive in absolute terms, we get to see a lot of arguments that say that equities are cheap in relative terms. And the argument that tends to be used is risk premium. People say, look, relative to fixed income, equities are cheap. And to do that, you need to transform an equity into a fixed income product, create through certain assumptions, an equity yield, which makes it look like a fixed income yield. And basically what one of the common mistakes that people make is they compare the equity yield with the 10-year treasury. And this is a big mistake, because when you look at that equity yield and that equity like fixed income, you see that we get to an average duration in the S&P of about 28 years. So the first thing you need to do is, if you want to compare S&P with fixed income, you should compare apples with apples. And the moment you compare the fixed income or the S&P with the equivalent, which is more like 28, 30 years, you see that there's actually no premium in equity risk premium. And this is something that explains why this high inflation and potentially higher rates could be very disastrous, not only for the S&P, but even worse for the NASDAQ, which is way more reliant on growth and long-term cash flows. And that's why it's something to watch, that sensitivity to rates and what it might mean for risk. So, and this is why, in my opinion, whilst there's a risk of tapering, which I think should happen, and potentially even hikes, who knows, which I will see what time brings. But I think there's also a possibility of yield curve control, which is, as you are tapering and reducing the incentives and potentially even hiking rates, you will do that by controlling the back end because of this dynamic. So I think this is something to consider. If you look at the equity markets, they've been incredibly steady. They've held extraordinarily well. The shocks are being dealt, buy the dip mentality continues to prevail. Things are working, and we are pretty close to all-time highs. Momentum-wise, the market, was overbought at some point. Things have stabilized much more significantly, and it does feel very, very resilient. So no imminent signs of panic on this side, on the technical side, and fundamentally we'll see how the market takes it. But again, we will need a meaningful stance or shock, I think, to shake this tree. But that is something that is relevant. As I've discussed at length, the inflation-deflation debate, there are so many deflationary forces in the system, but ultimately it's just one that kind of offsets them all, and that's called money printing. So the famous inflation versus deflation or reflation debate, it's interesting. Reflation is more about kind of a lot of demand for goods and prices go up. Inflation is more about a lot of money printing, and so it's about the value of the money going down. And that is really, in my opinion, what's happening. Commodity markets have had an incredible run, 45 to 60% move up in more cyclical commodities like crude oil or iron ore or copper since last summer. And gold, which has kind of bounced a bit from the lows, is still about 8% of the highs. I think gold is due to some catch up, and I think some of these dynamics of gold versus fixed income are to be broken, but we'll see. The robots and a lot of people in the market continue to see those relationships holding, and they become self-fulfilling prophecies. But I believe that gold is extremely well set to perform very strongly on the inflation theme. And another angle to look at this and the relationship between copper and gold, you see this disconnect, which in terms of potential catch up, my point has been that I think the catch up happens with gold higher, not copper lower, and that's been the case since I put I borrowed this graph on the first time I showed it. I think it's about gold catching up rather than the others collapsing in the absence of a major shock, which could potentially accelerate the move further because of the decrease on the commodity side and more accommodation in higher gold. But I think again, my view on gold is well known. Most of you are, I guess, familiar with the book, the thesis, the view that gold is, in my view, an anti-bubble. We've continued to see central bank buying. I mentioned this, the pretty meaningful purchases. Hungary a couple of months ago, now the BIS. These are sizable holdings. Yesterday or the day before, the Sovereign Wealth Fund of Russia, kind of in response to some of the issues, announcing that it's going to de-dollarize, and gold is potentially one of the big winners. So I think gold is well set also on this hand, which is the central banks are truly diamond hands in the lingo of the millennials. So I think in that sense, the ETF, the emerging market, I mean, we need to see also how Turkey, for example, despite the lack of trouble in the markets, we have seen the Turkish lira depreciate to all-time lows. And this is part of the reason why the countries like Turkey are such big buyers of gold. They don't trust their currency. They want to park it. They believe also perhaps in Bitcoin, but it's been forbidden in Turkey for obvious reasons. And basically, this leaves us with a situation where from a physical flow perspective, I think the currency devaluation, the lack of faith, will continue to be a support, even if physical has its great advantages and disadvantages. From a technical perspective, gold was clearly overbought in the last move up. I think it's this recent sell-off is somewhat healthy. You see on the right-hand side, these purple or lines or violet lines showing you sort of some of this overbought nature, the RSIs. This recent move, which this morning brought gold to 54 now, as I got into this call, it was more stabilized above 80. These kind of cleanups are needed. Some of the short-term players' momentum that get on board sometimes need to be cleaned up before you get the bigger moves. But my view is, we've broken back above the key levels in terms of the moving averages, and I think the picture is set, hopefully, for gold to retake all-time highs in dollars in the next few months. With that, it's very important, and I always talk about this. It's one of those things that it's a bit like health. You only think about your health when you don't have it, or some people do. volatility is a bit of the same. It's easy to forget that volatility exists because you're now in a low volatility regime, but I keep insisting that the trigger to big hostile markets is likely to come through the volatility channel, one of the key anti-bubbles. Volatility for me is the speedometer of the markets. We see how processes where implied volatility goes up effectively can lead to processes where as implied volatility goes up, the value at risk goes up, and this creates forced liquidation. Forced liquidation can result in thinner liquidity, the ability to sell a given amount at a given price in a given time. And when everybody is on the same position, then you get to see also correlations increasing. And this effectively process of higher volatility, thinner liquidity, and increased correlation creates exponentially higher value at risk, which kicks on itself and can actually lead to more liquidation, more volatility, etc. And this is the reason why the markets, and I love, there are many things I like about Ray Dalio, but I think his view of the markets as machines is very accurate, particularly during, and funnily enough, during chaotic markets. So when you move into your turbulent regime, when volatility explodes, and I use 40% as a line in the sand to potentially when do things go turbulent, when do things get out of control. And but it could be lower if you're coming from a very low base. But these price moves, these volatility moves are very difficult to stop once they go. And so it's something to watch. Now, the VIX is obviously an incredibly effective hedge, but it has a major problem, and it has an incredibly negative carry. So whilst you might look at the VIX as an index, the actual is not an investable index. So if you want to invest in the VIX, you need to buy the futures, you need to roll them, and that comes at a cost. But you see that the VIX is a double-edged sword. You know, there are situations when the VIX explodes that markets collapse, but also scenarios where the VIX becomes much lower, and that effectively forces or sucks people in through a melt-up situation. And so this dynamic of volatility much lower can contribute to equities much higher, and that's something to watch. As I was mentioning earlier, the unfortunate news is the relationship between the index and the investable is such that the very strong negative carry has meant major losses in even with nominal gains on the index. Since we launched Igneo, for example, you see truly major losses in the actual investable stuff. So the VIX, as much as I love it, and it's a key part of it should be of portfolios, is extraordinarily difficult to play, extraordinarily expensive to hold, and this is very challenging. Last month, Igneo was up above 13%. The VIX was down again 13% in the month. So that makes perhaps our performance even more remarkable, considering our defensive nature. But yeah, with the VIX, as I was explaining, this is really about the shape of the curve. Not a bit more than a year ago, we had this kind of curve, incredibly high market in the front, expectations of things coming down, which they did. But more recently, carry that is in excess of 10% per month, which is just simply very difficult to play. So to do this, we need to take advantage of a number of things. The market is offering you right now, this is the options, the implied volatility for options on the VIX based on a contract around 19. You see the at the money is in terms of volatility is around 113, 110, 115. That's super high. But look at the skew. I mean, at the bottom you see the implied volatility for strikes like 30, being 186. So that's kind of 70, almost 70, 75 points in volatility, almost not quite double. But so tremendous amount of demand. The distribution, probability distribution, is paying a ginormous premium for these big spikes, and from a technical perspective, is somewhat scary. What could be ahead of us if and when we see another big blow up. I think there's something in the making. You may trust or not the technicals, but we've seen a lot of compression, and it's a matter of time perhaps that we see one of these very, very big moves, which is in a way what the market is scared about and is in some ways telling us. So interestingly enough, obviously, this has been a very, very wild month for the crypto space. I think I've remained, in my view, for those who are not familiar, please go into LinkedIn and read my article, Bitcoin Bubble or Anti-Bubble. My conclusion remains unchanged. I think it's 80% bubble, 20% anti-bubble, many fallacies at play. But we've seen many of the pillars now, falling apart with a civil war, literally, between the cryptos, with Dogecoin coming out of nowhere, and in my view, reinforcing my view and showing that the fallacy of scarcity, right? That there's only 21 million Bitcoins, but you can print 21 million cryptos out of thin air. Big debate. I think I'm actually surprised in some way that the big move down that had a drawdown of over 50% hasn't had a bigger impact. The answer perhaps is, well, first of all, despite being trillions of dollars of wealth effect destruction, everybody knows that wasn't real. It's not money that went into something else. It's largely money that never existed in the first place, and it just showed as an accounting entry, but it wasn't real. It's a well-known, in my opinion, bubble effect. But I was fearing perhaps a bigger move. It's interesting, and I made this point before, how the move down and when things were getting ugly, gold was rallying strongly, which sort of confirms my view that some of the crypto community was not just the long Bitcoin, was also short gold, and that worked for them for a while as their enemy, and their fallacy and their narrative was about nice shiny rocks and the kind of stuff that they talk about. I personally think that gold remains intact. Many people like both. I believe gold is very well positioned, and I continue to call for caution on the crypto space. Happy to discuss in more detail if you want, but the risk is, people like Elon Musk. We know exactly where he bought this thing. We know people like Michael Saylor, very transparent about how much they bought, the leverage they have. So the writing's on the wall. We know where these firms go, negative equity and forced sellers, and there's ginormous amount of hidden leverage in the system with Tether and other things that make me very, very worried. So a lot of caution with this. It hasn't become systemic yet, but there's a possibility that it could be a much bigger problem arising from here. So far surprised it hasn't really had a bigger effect, but I understand why. Perhaps the millennials that buy this are not really the same buyers as the S&P, but they certainly are the buyers of Tesla and ARK and the SPACs or whatever. So it's all the same FUD in my humble judgment. Time will tell. So with that, I made the point earlier of the strikers, the defenders, the inflation, and we go back into perhaps Igneo. I know this month's discussion again very, very much on tapering, inflation, etc. But from a month-on-month basis, Igneo's had a nice move. I believe that hopefully we're in a strong position for what I think might be ahead. We are, as we'll see now, well positioned across the different buckets, and so it was about 13%, over 13% return on the month. Still negative, unfortunately, for the year, but we'll try to fix that soon. And some of you came in early, some of you came in later. I sincerely believe that we have the possibility to perform strongly and reach all-time highs eventually. We've certainly accumulated a lot of insurance that could be paying very significantly. So with that, I use these graphs to show, back to the team, and this is about behavior, it's about factors, is about how do you do when volatility goes up, how do you do when different things happen. And so our behavior is hopefully going to be somewhat predictable. We'll try to deliver on our objectives and this idea of defending gets well illustrated when through the avatar, where you see Igneo being a very strong score on the defending side, less so on the offense, which is almost a mirror image of the S&P. Now you look at this zigzag, this theme of the correlation between the S&P and Igneo is very obvious, very negative. This is something that is very desirable in a portfolio, particularly when you're looking at two assets that are both positive. Okay, if you had a S&P -1 and ETF -1, you would have lost 58%. So this is about generating positive returns through different paths, and the more different, the better. And so in this case, our construction makes it a very good team player for to go along with risk assets like the S&P. The fact that they're ahead of us now, it's fine, it's anecdotal. We've been ahead of them for a long time, and who knows, we might catch up and reverse. But I think that the team together goes well. So in that sense, continuing, this is something that I mentioned that is not a coincidence. It's something we try to achieve by mandate, by construction. What you see in this graph is the worst performance monthly on the S&P from worst to best, and you see on the left-hand side how pretty much every single time the S&P is under pressure or consistently at least we've done well. There's obviously been exceptions, but hopefully we're trying to generate this asymmetry, more of a put profile, long inflation. So when you think about the team, the easiest way to think about the team is just take $100 and put 50-50, and here just you just let them run, and what you would get if you did that is the weighted average of the two performances, is the dotted green line. But as I've mentioned ad nauseam, over and over, the portfolio performance is hopefully greater than the sum of the pieces. And this is what happens when you build a team with negative correlation. In fact, your rebalancing processes, when you buy cheap and sell expensive, or vice versa, sell expensive, buy cheap, allow you to generate incremental returns. And what you see in our case is this is a very significant outperformance. So we've generated almost 5% more by simply sleeping at night, by not being emotional, by basically buying, rebalancing the portfolio back to 50-50 on a monthly basis. And this is really, I call this in stable return, I call the compounding epsilon. For those with a mathematical background, it's sort of the error or noise factor. It's what basically squares the accounts. And epsilon is a very, very powerful strategy because it's a mean reverting strategy that will generate incremental returns. These are returns that your eye doesn't see, but they're very real and very meaningful. And this is why you want to build a team. You don't want 11 strikers. You don't want 11 goalkeepers. You need both. So this point becomes magnified when you build, you take advantage of this and you build Aqua, being 80% Igneo, 80% stable return. And you see how it works, right? Here, the beauty, and going back to the team, is that you want to have strikers and defenders, but in this case, both of them are long inflation. So a month like last month, where both are up, is not inconceivable. And I think this could be more normal in inflation. And then when things go really wrong for the risk side, hopefully Igneo will come in to the rescue as well. But Aqua is being approved. We had it's already, it hasn't been launched. We're gathering interest, and some of you are investing directly through Igneo and the S&P separately. Some of you expressed an interest to do it in a combined fashion, and very happy to discuss further. We are totally agnostic whether you want to do one piece or the other or both, because it's exactly the same. We're just managing Igneo. Aqua is just replication done on a systematic basis. So we're not being diluted. On the contrary, we just have the single strategy that we can apply for investors with different needs. With that, going into the portfolio positioning, let me, for those who are not familiar with the strategy, there are three main building blocks: precious metals, roughly about 50%, long bias, we can buy puts to create a rolling synthetic call, treasuries, roughly 25-30%, treasuries and nominal treasuries and tips, generally 10-year duration, but we have the ability to increase or decrease. But then the options bucket, which is roughly 20-25%, and where the key thing is that we only buy options, and we have two main choices. We can buy either calls on anti-bubble, anti-crisis, or puts on risk assets. And in that sense, the strategy doesn't have any linear leverage. There's no leverage on the core building blocks, and we only buy options. So yes, we can lose money, of course, but we can't necessarily blow up due to leverage or be taken out by the market. So you want to be in a situation where that long insurance gives you the right asymmetry. So what are the candidates? We use obviously there's a bunch of choices for the option bucket, or for the defenders is gold, is volatility, is inflation, is treasuries, is the dollar. We have a long gold, long dollar position. This might look that it's like offsetting each other. Yes, it can do. So for some periods of time, they might be offsetting each other, but during periods of crisis, you could get actually both higher. And there's certain events which we think could be ahead of us, scenarios potentially shocking the market of gold higher, dollar higher. This is particularly true during hostile events. We use, as we know, not only vanilla options, also, and I'll discuss this in more detail, other more exotic and correlation plays, which allow us to fine-tune our bets. The big contributor here, you see the attribution of P&L since launch by different buckets. You see the big swings at the bottom on a month-by-month basis generally come from the options bucket, how they can be very explosive during crisis, and how this accumulates through time. This table, for those who see it for the first time, represents the premium at risk. So if you have invested $100 with us, right now you would have 25.7 in option premium. You can see that on the table at the bottom right. This is split across in time horizons, and it's split also across different underlines. We are particularly long on gold on 2021. This has been the result of accumulation of positions on this move that I consider to be somewhat artificial and a big opportunity for us to accumulate. And we will be taking profits on the way up, hopefully, a lot of that. But we have a lot of stuff up there that could perform really well with also nice asymmetry and nice carry. At the bottom, you see in a little bit more detail how we combine gold and different pieces. So expanding on the table above, and you see things like S&P and VIX and others, which as we discussed earlier, I think are potentially very, very good, very asymmetric, even if they could be a very negative carry. You want to find ways to mitigate that. So let's look into some of those ways to mitigate, and I've discussed this in previous calls, but we use different payoffs to take advantage of this. The point here is we're trying to be very diversified across multiple dimensions: time horizon, underlying, payoff, etc., strikes. And here, is a challenge. Within a long only option world, which means the worst case scenario is always the premium. You're going to try to find the right trade-off between important considerations such as, how reliable is the insurance? So if gold goes up, I make money. If S&P goes down, I make money. How asymmetric it is, how expensive it is, how much is my carry, what is my break even? So I feel that whilst vanilla options are the best thing in the world, they can be expensive, and so I think it's good to have this combination. But most important is to have insurance that is reliable, will do their job, and that's where you can beat vanillas. This is an example I used last month as well. It's just a plain vanilla gold call, and I use it as a reference so you see the asymmetry of the trades. And whilst it's very asymmetric, you could suffer negative carry throughout time, and then you have this long volatility, long delta, long direction. What you see in some of the payoffs that we've been using are a little bit more interesting. And when I first started showing you this, in fact, I haven't changed the line. We were down there at more negative carry levels. As we've moved to the right and gold has gone up, you see that our book starts to be much more neutral or positive carry. So as time goes by, the red line converges to the yellow to the green. The green line shows the payoff at expiry. The red line shows the value of this option strategy at a certain point in time based on different prices. And so as gold goes up, you make money, but also you can see what happens as time goes by with gold unchanged. So it's I think a very visual way to show potentially the value of this high call skew, which allows us to get cheaper insurance with very asymmetric profile with positive carry as things go your way. We have been actively restructuring, as I mentioned, and taking profits. This last month, we already took out some positions, but we have others that are kicking in. And we have a similar, almost mirror image picture for the S&P. So we have 4,000 puts that would have cost us a fortune and would have been bleeding like crazy, which are behaving much better because we basically sold that bottom barrier, which makes the strategy, I think, much better. You obviously don't have the full upside if the S&P collapsed under 3,000, but you would get the right direction and a lot of very nice carry as you approach expiry. So it's a nice, I think, way to play the market. I talked several times about China and Taiwan. I'd like to bring it back again because I continue to believe that this is a source of potential geopolitical risk. It has been pretty much one-way street in terms of the appreciation of both currencies versus the dollar. But we have accumulated insurance that is gold higher versus these currencies lower, which could happen for multiple reasons. But it's not just a directional option view, it's also implied volatility. So these options are now somewhere around 50-1. So relatively small risk to potentially big payouts. And this is a technical point, but it's also on the term structure and positive carry of the Taiwan dollar, which is a bit of an anomaly in the sense that you are potentially long tail risk with positive carry. For the time being, it hasn't worked. The gold leg is now performing better, and this trade will morph more into a dollar call against China and Taiwan as time goes by. With that, for those who are not so familiar with those options, that terminology I was using earlier, these are examples of payoffs that we use that, for example, we have one of these guys which is gold higher, S&P lower, you only get paid on the graph on the left if the two conditions are met. But based on the distribution of probabilities, you could get really asymmetric payoffs. We tend to do this at 10 to 1. So we risk 10 cents to make $1. Or even with more leverage, you get the worst of, which, for example, we have one expiring next week that is gold higher, euro lower. And these are incredibly cheap because, as you can see in the graph, they're not likely to pay up a lot. You require big moves in opposite directions. And if the market is implying positive correlation, then the probability that you end up in the dark green box is very negligible. So the good news is that you can accumulate these things extraordinarily cheap based on the implied view of the market. And during crisis, they can be and pay very, very nicely. So with that, I believe that we've covered a fair amount of ground with respect to the big macro view, the portfolio, etc. As always, I'm gonna open it up for questions, and I'm gonna stop sharing the screen. And I'm gonna go and check the questions. So if you have you can see the chat; it's already open. I'm gonna go through them, and if you have more questions, please feel free to put them there. I'll try to go through them. So the first question comes from Peter. Hi, Peter. It's about inflation. Inflation was the boss, and now the bubbles are the boss. I agree. Can you talk about the gray area in between? For example, central bank waiting for inflation, but not when they first burst the bubbles. What can they do? What are the consequences for gold? I think this is really important because this is where we are. So central banks, in a way, want and need inflation, and governments to as a way out of the debt problem. At the same time, inflation would, if to the extent that they need to address it, because it can accelerate and have nasty consequences for stability, then to the extent that they need to stop it by hiking rates and reduce all the printing, this is in a way going to show to what extent the current bubbles are bubbles or not, or they are more or less sustainable. My opinion is they are much more fragile than they look, and we are at a point of no return. We're past the point of no return. I think that the idea of normalizing monetary policy would result such a big move down in risk assets that would be catastrophic. It would so that gray area is almost, as you call it, is kind of the sweet spot, because they have inflation which is sufficiently high that it will dilute the problem, but at the same time it's actually positive for risk markets whilst it's contained, and that creates wealth effect. People feel rich and they will spend more. The consequences, the negative consequences of inflation and inequality and etc. are brewing, and I think this is something that is it's gonna come, and it's already happening with increased forms of populism on both spectrum. So I think your point is correct. I think they have a sweet spot. They want that gray area is where they want to be, and they will, in my opinion, let inflation run quite hot until they have to do something. And I think by the time they have to do something, it will show that they can't really do much or what they should do to stop it. So I think we're in a new paradigm of very, very negative real rates. So moving from the current sort of -2, -2.5 to easily 3, 4, 5 negative. And again, that's depending also on what sort of inflation you look at. But I think this is the risk, and that will be very, 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 very positive for gold, in my opinion, and for most real assets. I mean, think about, here in Spain, 25-year, 30-year mortgage, you can lock in your rates at 0.75 fixed. I mean, this is just absolutely incredible with no penalty. So you can actually repay early. In a world where inflation is going to be higher than that, the incentive is buy the biggest house you possibly can, fix the rate, and to the extent that there's no blow-ups, I think that inflation is going your way because the value of your house goes up and the value of your mortgage remains unchanged. And to the extent that interest rates could go up, which I kind of doubt it, with already rates at those levels is somewhat asymmetric. Even if a world of central bank digital currencies, which is sort of that next phase of the crypto, so they think it's really bad news for crypto, but that could take us into the much deeper negative nominal. So I do think we're in a paradigm shift. That level 2 in the video game I was talking about is real, and it's something to watch. I'm going to move to the next question. What is my opinion on crypto as a potential hedge against inflation? I mean, I said it earlier. I believe the credit of crypto, or for something to be a good inflation hedge, it has to be, you cannot print it, right? So if you can print a lot of things. You can print currencies, you can print equities, you can print bonds, you can print tons of things. You cannot print real assets. You cannot print land. You cannot print oil. You cannot print gold. The big debate is, can you print crypto? And the biggest argument from the Bitcoiners is there's only 21 million Bitcoin. You cannot print it. But I think that's a fallacy, because as I said earlier, you can actually print 21 million different cryptos. And then we get into debate of the first mover advantage. Yes, you could do 21 million Googles or Facebooks, which obviously completely misses the point of one is a company with revenues and the other one is not. And it looks more like art or gold, for that matter, where the value might be slightly more subjective. But I think the fallacies continue with things like Metcalfe's law and network effects, which basically pretend that again, they create this narrative about the value of a network. For those who are not familiar, the network effects are kind of the mirror image of economies of scale in the supply side. On the supply side, it's easy to understand. If you have a factory that produces 1,000 units and now you do 100,000 units, you would expect the marginal cost of production to go down. Network effects are a little bit the opposite. Is this idea that the more demand, the more you're willing to pay for something, and that comes from this Metcalfe's law, which says that the utility of a network, of a neural network, increases proportionally to the square of the nodes, which basically means you can interconnect everybody with everybody, and so the more nodes, it becomes exponential. But the basic mistake, in my view, is you're confusing utility with price. Okay, the fact that the utility of a network, of a telephone network or whatever, increases exponentially doesn't mean I'm willing to pay exponentially more for the calls. So I don't know. At the end of the day, as I said in the paper, I don't want you to think like myself. I want you to think. That's Frida Kahlo, by the way. And the arguments I push forward are very much. I believe Bitcoin is more of a bubble than an anti-bubble, but it has some merits on the technology. But anyway, I would urge for caution. Just in the interest of time, I'm going to be, as you know, I do, after this presentation in English, I do another one in Spanish, pretty much identical. So if you guys are interested, you feel free to join. But there's a question on Basel, I guess. Look, a lot of noise very often with these things. we'll see what happens with the banks. I don't have. I don't think it'll be as big of a catalyst as a lot of people are arguing. But certainly, any measures that have balance sheet requirements could potentially expose leverage one way or the other. So something to watch. I see it as a slight positive or positive, but not necessarily something that in my view is an absolute game changer, but happy to be proven wrong. I'm just going to run slightly faster because of the time, but there's a question on carbon emissions, carbon credits. Look, I guess it's because of my involvement in the energy markets. I can tell you that, it's interesting. I'm not following as closely. There are big opportunities in the US from what I gather and I see. And I have a lot of experience in previous phases. We were first movers in the first phase of European permits. And I think the system is, at that point in time, the system was gamed to a binary outcome. I'm not following us as closely, but if you're interested, I can connect you or I can pass a lot of information from people that are much more closely into it. I think some of the banks are doing an excellent job and coverage. I take the opportunity to bring it with respect to ESG, and I think for those who didn't get my update, we're obviously very focused on the ESG side, but to prove my point, we hired Jarkko Matalainen, one of the leading institutions in Europe on hedge funds. He was the former head of hedge fund at Varma, the largest player of hedge funds in Europe, which is a Finnish mutual an insurance company. So we're extraordinarily pleased to have Jarkko on board. He's not only an institution in the hedge fund space, he's also been an institution in the ESG. He was chairman and responsible for writing the United Nations PRI document on ESG in 2011. So he's now on our board. We've added additional people, and we're excited to bring new ESG strategies over the next few months. I'll be happy to share with you some very exciting projects, including a new fund with Latin American equities that is super, super strong and exciting. I won't be running it. It'll be a completely separate team with 9 full-time dedicated professionals from Banchile, but this will be super exciting for us, natural expansion of our partnership, and I look forward to sharing with you the information when available. Last question, I think, or maybe a couple more. Such a Renaissance man, my good friend Kapil. So yeah, thank you, Kapil. Our offering today is quite global. We've been opening a lot of new channels. Strategies are available even through interactive brokers. We are we're raising all funds, Pershing, and now or soon with UBS Clearstream Fund Center. So these are the major supermarkets which give us connectivity to all the smaller banks. Unfortunately for the US onshore market, we continue to have a bit of a gap, and I know that some of you have been incredibly patient. But yeah, we do have some solutions, but they require some size and other considerations. So we're working on it. Thank you for your patience. In the meantime, I hope the updates do help, and there might be proxies you could use to get your goalkeepers on the team. With that, I don't know if there's any additional questions, but as always, I really appreciate your time and your support. We've continued to see inflows, which is great, and I think the time now is an interesting one based on the overall picture, and hopefully a good time for you to continue to hold, but obviously and possibly add, because I think it's going to be a very interesting next few months. Best of luck to everybody, much health, and anything I could do, drop me a line, and happy to elaborate as needed. So God bless. Thank you.